Let's get right into it. Welcome to this executive masterclass explainer on how global capital actually shapes the property market. If you've ever looked at a towering skyscraper or one of those massive logistics hubs and thought, how exactly does that get funded? Or wondered how local bricks and mortar connect to this massive pool of borderless financial liquidity, well, you're absolutely in the right place. We're going to look way past the physical buildings to uncover the sophisticated financial engine running the whole shebang.
Now, this explainer specifically distills some incredibly complex financial insights from WRT Publishing and the authoritative work of Willem Tate. We're taking Tate's comprehensive framework and bringing it to life, essentially bridging the gap between two worlds that might seem totally distinct: the tangible, physical reality of real estate and the fast-paced, highly abstract world of global finance. It's about turning theory into actionable, strategic knowledge for your portfolio.
So here is our roadmap. We're following a structured top-down academic approach, hitting 5 key areas: the financial ecosystem, equity and debt financing, securitization and institutional capital, market risks and economics, and finally, the future of real estate.
Starting off with Section 1, the financial ecosystem. Let's lay out the foundational pillars where tangible assets actually intersect with global financial liquidity. You know, there's a really brilliant synergy at play here. Capital markets act as this dynamic, global reservoir of funds. They're highly liquid and fast-moving. Real estate, on the flip side, is perfectly tangible. It's physically stable and acts as this incredible safe haven to hedge against inflation. When you put them together, it's magic. The dynamic liquidity of the capital markets fuels the growth of real estate, while the real estate provides that resilient, income-generating stability that financial investors absolutely crave.
To put this into perspective, just look at how a massive, say, $500 billion sovereign wealth fund allocates its capital. Dedicating exactly 10% to real estate acts as a vital portfolio stabilizer. Why? Because it doesn't move in lockstep with equities or bonds. While 20% in equities gives you high growth and 30% in bonds gives you stability, that 10% slice of real estate perfectly bridges the gap, offering both steady rental income and long-term capital appreciation. It's a total game changer for balancing risk.
But here's the catch. The defining challenge of real estate is its inherent lack of liquidity. I mean, you can't exactly buy or sell a commercial skyscraper with a single click, right? That's where capital markets step in. They provide the crucial liquidity mechanism that physical properties just don't have on their own. By transforming illiquid buildings into tradable financial instruments, money can flow seamlessly between the people who have capital to invest and the developers who need it to build.
Moving right along to Section 2, equity and debt financing. Let's see how this builds into the actual mechanisms used to fund development on the ground.
The absolutely crucial takeaway here is understanding the strategic trade-offs between selling an ownership stake versus borrowing against collateral. With equity financing, investors hand over capital in exchange for an ownership percentage. They're sharing the risk and the reward, which makes it super flexible. But, the developer has to give up some control. Debt financing, that's strictly borrowed capital. You have a strict, non-negotiable obligation to repay it with interest, and the property itself is sitting there as collateral.
If we zoom in on the equity side, real estate investment trusts, or REITs, have literally revolutionized the space. They've democratized equity by making large-scale property investments liquid and accessible. Instead of needing, say, $50 million to buy a commercial office building, you or I can just buy shares in a REIT on a public exchange. It pools capital from thousands of investors to manage these massive income-generating portfolios, and then it pays out the rent as regular dividends. It's brilliant.
On the debt side, you've got a whole toolbox of instruments scaling from your standard commercial mortgages all the way up to massive municipal bonds that fund entire city infrastructures. Mortgages are the bedrock, obviously, but larger corporate developers might issue corporate bonds directly to the capital markets. And if you need to bridge the gap between equity and senior debt, well, mezzanine financing steps in, offering higher yields for investors who are willing to take on just a bit more risk.
Okay, Section 3, securitization and institutional capital. This is where we examine the sophisticated financial alchemy that transforms local debt into global investments.
So, you might be wondering, how does a local commercial mortgage actually end up being traded on international capital markets? Like, how do we get from a physical brick building in Chicago to a liquid financial product traded in London or Tokyo? The secret sauce is a highly structured financial mechanism known as securitization.
Let's break this down step by step. First, an originator, like a bank, creates the loan. Step 2, to isolate the financial risk, they transfer those bundled loans to a legally distinct entity called a special purpose vehicle,
or SPV. Step 3 is where the real magic happens. That pool of loans is sliced up into what we call tranches, organized by varying levels of risk and return. And finally, step 4, those tranches are issued as securities and sold off to global investors.
Now, these securities generally fall into two distinct buckets, catering to totally different strategic risk profiles. Residential mortgage-backed securities, or RMBS, are generally lower risk, offering predictable returns because they're backed by thousands of everyday home loans. Commercial mortgage-backed securities, or CMBS, on the other hand, are backed by commercial assets like retail centers and offices. They carry a bit more risk due to market volatility, but they offer the potential for significantly higher yields.
And who is buying all these securitized products? Mostly massive institutional players managing billions of dollars and hunting for reliable, long-term yields. Pension funds absolutely love real estate because it perfectly matches their need for long-term, stable income to pay out retirees. Insurance companies use it to balance liquidity against reliable returns. And sovereign wealth funds, they're using these assets to diversify entire national economies on a global scale. It's huge.
Let's dive into Section 4, Market Risks and Economics. We really need to look at the macroeconomic forces and systemic risks governing this whole interconnected ecosystem.
As an executive, you absolutely have to keep your finger on the pulse of key economic indicators: GDP growth, inflation, and interest rates. These are the ultimate compass for real estate capital flows. GDP growth signals an expanding economy, driving direct demand for space. Inflation is kind of a double-edged sword. It drives up construction costs, sure, but real estate is a great hedge because property values and rents typically rise right alongside it. And of course, interest rates, set by central banks, dictate the fundamental cost of capital. That directly impacts the viability of literally every single project.
Now, what's fascinating here is seeing how these globalized markets expose developers to really complex cross-border risks. We're not just talking about a tenant defaulting anymore. If an international fund invests in a foreign property, a sudden shift in currency exchange rates can completely wipe out their yield. Or think about regulatory changes. A sudden shift in zoning laws or foreign ownership rules can instantly alter a project's entire financial trajectory. It's a complex puzzle. But even with those inherent risks, globalization continues to create absolutely massive cross-border opportunities, especially in rapidly urbanizing emerging markets. Thanks to digital data analytics and better trade agreements, a pension fund in Europe can now seamlessly finance a state-of-the-art logistics hub in Southeast Asia. This borderless flow of capital accelerates development all over the globe, tying the fate of local physical assets directly to the pulse of international finance. Which brings us to our final part, Section 5, the future of real estate. Let's examine the technological and sustainable disruptors that are completely redefining the industry's horizon.
I want you to consider this stark metric for a second. Buildings account for nearly 40% of all global carbon emissions. That makes ESG compliance, environmental, social, and governance, a critical financial imperative for securing future institutional capital. These aren't just buzzwords anymore. They are hard, non-negotiable metrics. Institutional investors are actively pulling capital away from outdated, inefficient assets and pouring it into green-certified buildings packed with smart tech and renewable energy.
And on the technology front, things like blockchain and tokenization are rapidly stripping away historical friction and creating deep liquidity in property transactions. Blockchain gives us this transparent, immutable digital ledger that can automate smart contracts and cut out expensive middlemen. Building on that, tokenization allows a multi-million-dollar property to be split into thousands of digital tokens. Basically, you could buy a fractional share of a commercial high-rise just as easily as buying a share of tech stock. It's completely democratizing access.
Because of these massive shifts, savvy investors are actively diversifying away from your standard traditional office spaces. They're looking at alternative assets, things like high-yield data centers and solar-integrated logistics hubs. The e-commerce boom requires ultra-efficient distribution networks, and the cloud computing revolution demands massive, energy-intensive data centers. These aren't just buildings. They're specialized, tech-driven infrastructure bridging real estate stability with cutting-edge growth.
So, I'll leave you with this final, provocative thought. In a rapidly evolving, borderless financial ecosystem, how will you strategically leverage global capital markets for your next big move? The bridge between capital markets and physical real estate is stronger, faster, and way more complex than it has ever been. Whether you're seeking funding for a sustainable development or looking to diversify a massive global portfolio, mastering this dynamic interplay is the key to unlocking true long-term value. Thank you for joining this Masterclass Explainer. Keep learning, keep analyzing, and we'll see you in the next one.